Hi, my name is Jonathan Wernick, and I work for Sasfin Wealth as a global equity analyst. And today I'm going to be taking you through the fourth quarter 2023 results for the global equity model. And to help me with that exercise, I'm joined by Craig Pheiffer. Hi, Craig.
Hi there, Jonathan. Great to be back again talking about the portfolio and the fund, and particularly good quarter, I think, for the fund. So that's always enjoyable.
Yes, it's a new year. We ended off the last year on I'd say a rather good note. Global equity markets returning about 11%, depending on how you look at it. Once again, we're at discussing the same thing: interest rates, central banks, particularly the Fed. I think the market's now changed its tone a bit, expecting the Fed to maybe cut rates. But why don't you just take us through a bit of the detail and what went on?
Yeah, well, leading into the beginning of the fourth quarter, even October, so sort of that August, September, October, the markets were really on the back foot. We had a terrible 3 months then, and that was inflation was coming out worse than expected. And at that point, the market couldn't really see when interest rates were going to turn. And the Fed was all hawkish. They were talking a story that, it's higher for longer. And at that point, we still thought that, we could even see rates go higher at that point. But as it turned out, the inflation numbers started improving. Over the quarter, we saw the US inflation going from sort of 3.9 to 3.1. So definitely heading in the right direction. The Fed the governors got a little more dovish. They just stepped back from their really tough stance to some degree. They still continue to wave a big stick as central bankers do. But it was the market got wind that, okay, maybe rates have peaked here. And the last hike we got was in July to that 5.5 level. And rates stayed there for the duration of the year. And it was really in November that things started turning. The expectation that rates would start coming down in 2024 the market started factoring in 1.5, 1.75% cuts in rates in the new year, and starting to expect it pretty soon as well, sort of first quarter, maybe pushed out to the second quarter. But definitely a change in mindset from the market, and maybe those Fed officials a bit as well. Once that mindset had changed, the market really ran, and November was a fantastic month. I think the market was up about 8% and we followed that through into December. So a little bit of a Santa Claus rally continuing there. So we had a fantastic 2 months of the quarter, which gave us an overall a great quarter's performance for the market and the fund.
Well, you mentioned the Santa Claus rally. I think what was a bit different about the strong performance this quarter was we saw a bit of a broadening out of the performance, because early in the year, when markets were up, it was pretty much driven by a small cohort of companies on the back of this AI hype or mania that's gripping the world, taking it by storm, so to speak. And the cohort that we really mentioning now is the Magnificent Seven, which we're going to touch on a bit later. But the rally that you spoke of and that Santa Claus rally, the broadening out, you could see it in the different sectors performing quite well over the period. That said, there was one sector that didn't perform that well, a bit of a black mark, so to speak. That was the energy sector. What's going on with oil prices?
Yeah, I think we're still the expectation that production is going to continue apace, and also the global economy is slowing. So maybe demand is not going to be as severe as previously expected. So demand continues to grow incrementally as time passes. Over the quarter, we saw the Brent price go from something like $97 a barrel at the end of September to mid-70s. And it's all about, as I say, I think expectation that production will continue, and economies like China that are great demanders of oil maybe also not growing as fast as they would hope, and they're not creating that demand for oil. So definitely pulling back.
You mentioned China there. Chinese equities continue to be under pressure. I know we've mentioned before, but maybe just touch on a couple of the reasons why Chinese equities just continue to struggle when the rest of the markets were up.
China's a region where makes up such a big part of the world, and there's a lot going on there. And you'd expect those equities to be in demand, but the Chinese regulators, the authorities, government still have their fingers too much in the market pie, and over-regulating, creating regulations, and the market just too much uncertainty about what they're going to do next. So although we would anticipate with China being such a big part of the world that it would be a much needed investable destination, I think the authorities have kind of turned investors away from and just soured the view of China as an investment destination. So, I think investors have rather said, let's go elsewhere and let the dust settle and see what happens and how it plays out. But just too much uncertainty around regulation. And that's hurt companies, and particularly a lot of tech companies, well, the market as a whole, as you said.
I think maybe stop it there and turn the spotlight a bit closer to home to our performance, our model. I think it did a little better than global equity markets, returning around 12% or so. And if you look at the performance, a lot of it came from individual stocks rather than just allocating to specific sectors. And we saw some really strong performances coming out of industrials, consumer discretionary. It's almost the market's willing to take a bit more risk, so to speak, with interest rates maybe coming down. And then we saw a couple of names in those sectors that we hold, Siemens and Honeywell in the industrial sector. On the consumer discretionary, we saw Amazon, Nike, Home Depot also had really good quarters. On the flip side, though, with the market maybe being a bit more aggressive in terms of risk, you saw the more defensive sectors maybe not perform as well. But while they still delivered positive returns, they underperformed the benchmark or the average market return. And what I'm talking about defensive sectors, I mean your consumer staples. We saw a couple of companies there with low single-digit returns. One in particular that had a negative return, Diageo. Maybe you can just touch on what's going on with Diageo at the moment and its underperformance.
I think in that consumer space, consumers have been under pressure all round globally. Higher interest rates globally, eating into disposable incomes, while we consider things like alcohol a staple and a go-to even in tough times. Some of those higher level premium brands people don't consume when times are tough, and maybe you rather have the Johnny Walker Red than the blue for a time. So I think that has hurt profits generally, but it's really about consumers' disposable income, and I guess also just broadly speaking. When those other stocks are running, those defensive stocks get left behind. When it's risk on and everything's flying, and we talk about the Magnificent Seven and some of those other companies that are showing, we've got 20% odd performance from some stocks, and the investors want to be in those high-flying stocks rather than maybe your stodgy defensive stocks.
Yes, I mean we saw that also in the healthcare space. Johnson & Johnson holding the defensive name, so to speak, also not performing as well as the overall market. Thermo Fisher, similar story, also dealing with a bit of a COVID overhang, as a bit of a destocking taking place for Thermo Fisher. The one healthcare company which actually had a really good quarter, and it's actually not so much on the human side, it's on the pet side, is our holding in IDEX. The company manufactures equipment for veterinary laboratories. Turns out if you have a pet, there's some piece of IDEX equipment that's being utilized. Had a really good quarter. And I saw quite recently they've launched a new platform, and platform is maybe just a fancy word for piece of equipment, which I think is just going to help the company continue to grow in the high teens, so to speak. And it's one of the reasons we hold this company. It just got exceptional returns on capital and growing at quite a pace. And some people are uncomfortable with the valuation for the company, but I think the growth rate and returns on capital justify that valuation. Maybe we can just talk about our reason for exiting AIA. You've touched on it before, but just the broad strokes again.
Yes, I mean, AIA on the surface and even when you dig into it, looks like a great company. It's set up well, got great dispersion around the Asia Pacific region, top brokers selling the insurance, and all round a great company, but I think hampered by that regulation, that overhang, and just by association. I think being in China, it's been a poor performer, and that's negatively impacted its growth and potentially its growth outlook. And I think while there's that uncertainty, we don't need to be brave and lead from the front and beat the Chinese drum. I think we also taken the view that we'll just stand back. Even though it's a good company, it's just tainted a little bit by the environment that it's in at the moment.
Sure. I think sometimes you just got to hold your hands up and say something's not working and cut your losses rather than trying to stick it out without knowing what's going to happen.
And it is a great company, but it's just, maybe it's not the right time.
Exactly. Well, we exit our position in AIA, but we did add a new position. We added a company called Meta, which used to be known as Facebook. Maybe you can just take us through some of the reasons why we were quite attracted to going into Meta at this point in time.
Well, I think Meta, apart from the fact that we only owned 5 of of the 7 at the time, I mean, it's always on the radar. It did have a torrid time before, but it is a company that fits our profile of growth and quality. And looking at the company, it produces a lot of free cash flow. It's more than Facebook. It's got Instagram and WhatsApp as well. So it's got these platforms.
And those platforms have billions of users. Individually, they have billions of users.
They're massive each on their own. Right. And they are platforms where they can advertise, and that's where they get most of their revenue from. They have got this foray into the metaverse and these fancy goggles that you're going to put on and have meetings and see your colleagues and all other kinds of uses. And that's been a big drain on some of that cash flow. But the fact that they've got all of that cash flow has helped them now develop, maybe the next big thing, the next big app, or whatever it's going to be. So it has been a bit of a drain, but I think overall, we just like the fact that it is a company that still has good growth prospects, even though it's got those billion users plus on each of those platforms. It's still got the opportunity to grow over time, and its quality credentials have kind of been proven already.
Well, yes, I mean, you mentioned they've been investing in the metaverse, which is basically just a fancy way of saying virtual reality or augmented reality.
Yes.
But the market didn't really like how much they were spending in that particular area, because it's still very much unknown how it's going to evolve, if anything's going to come of it. And their CEO, Mark Zuckerberg, actually had to cut back a bit on some of the costs for the company, which I think the market was feeling a bit more comfortable with that spending, maybe reducing a little bit, but they're still spending heavily on the metaverse. I think what really served as a catalyst for Meta was when ChatGPT was launched late 2022. But when this whole concept of AI just re-emerged, Meta was so well positioned to develop applications, be it large language models, applications in terms of advertising. And that's also one of the reasons why we really like it. And in terms of the metaverse, there's this really interesting crossover with the metaverse and artificial intelligence. For example, they've got this partnership with Ray-Ban now, where you could be walking around with these sunglasses and you've got this almost screen right on your eye, but it's a what you'd call a digital assistant that will give you information while you're looking at something. And we could be heading to a world where the next big device moves from a smartphone to maybe something we wear on our heads. We don't know, but they're very well positioned in that regard.
Yeah, pretty pioneering. And I guess that's the thing. You have to spend money and see if it works. And if it doesn't, you move on to the next thing. But it does take a lot of capital and insight and IP to get going. But it does take some time before it's kind of established. Talking of Meta now, so now the model, we've got 6 of the Magnificent 7. They've had quite a run this year. So what's your take on still investing or still staying invested in those 6? And why don't you think we've got Tesla?
Well, I think let's take a step back, and for those that don't know, who are the Magnificent Seven?
Right.
Wall Street loves an acronym. It used to be the FANGs. I think they moved on to the Magnificent Seven with a bit of a Western theme. But the companies that make up this cohort is essentially, you've got Apple, Amazon, Alphabet, which is the parent company of Google. You've got NVIDIA. They are a chip design company. You've got Tesla, you've got Meta, and you've got Microsoft. And they've been labeled the Magnificent Seven. And at the end of the year, they were the largest companies on the S&P 500 by market cap, and it's probably why they've been called the Magnificent Seven. They all had really good returns last year, some of them close to 200% in 1 year, which also made a lot of people quite scared, because when you see that kind of return in 1 year, you immediately think the next year is going to be quite poor. People taking profits, or they're overhyped. So there's a lot of concern. There's a lot of concern, and maybe some of it's justified. I think from our perspective, we've held a couple of these companies for quite some time now, even before they fell into the Magnificent Seven naming bracket. And we hold them because they're really good businesses. They generate enormous cash flows. They've got high returns on capital. They are involved in markets with very, very large opportunities, markets that a lot of companies don't have access to. They can't grow at the rate these companies were growing. I think you have seen a bit of a transition where their growth might moderate to a certain extent. And what I mean by that is, instead of growing 20% per year, maybe they're going to grow 10, 15% per year going forward. We don't know, but they're still going to be growing. And it's because they've got these large markets in which they can grow into. These type of markets I'm referring to, digital advertising, you've seen a massive shift away from traditional formats, be it media, the formats of television, radio, print. People are moving to digital. In terms of cloud computing, the world used to have their servers on their premises. Everything was on premises. Now things are moving towards the cloud. It's just a better business model for companies. It's just a cheaper offering. You don't have to deal with the headache of IT maintenance to a certain extent. And I think that secular trend's still very much in place. We've seen a bit of a slowdown in it when people had to cut costs, but the percentage share of cloud computing for overall IT spend is still quite small. So there's a lot of room to grow there. All that said, I think the real catalyst or big event for these companies is AI. AI could be a game changer for these companies. They're all very well positioned to benefit from AI if it does take off. They're almost the gatekeepers or the top of the funnel when it comes to AI. If people are going to want to access computing power or some kind of AI model or AI application, chances are you're going to go to one of these companies to access it, be it the hardware, the software, because that's essentially what AI is, a combination of hardware and software. And these companies are the gatekeepers that are going to deliver that essentially to people that want to use AI, at least in these early stages. You did mention we don't own Tesla. It's got nothing to do with the founder and people's views on the founder. And, everyone has their own view on what Elon Musk is and what he does. The reason we don't own it is it just didn't fit our quality process. We've got quite a I don't want to say involved process, but we go through
rigorous. Yeah.
It's a rigorous process in terms of deciding what a quality company is and does it fit the mold of what we consider a quality growth business. And at this stage, Tesla doesn't fit that mold. It's not to say Tesla's not going to do really well, and if it does, we're going to lose out, but we're comfortable with that because we want to just stick to our process, because we think that's going to drive performance for us in the long term, having a rigorous process and sticking to that process. So that's the reason we don't own Tesla right now. Maybe one day it will somehow fit into that quality growth buckets. I don't know. If it does, then we can have a look at it again. But for now, we don't own Tesla.
The key to that process is having a proven history of constant delivery of those free cash flows, the profits, and that reinvestment of that. And the companies, maybe its sin is that it's just too young and it doesn't have that history just yet. And it may develop that history. And as you say, then based on our process, we'd look at it again.
Exactly. And I think on the Magnificent Seven, or for us, the Magnificent Six, we get asked the question, are we comfortable still holding these companies given how well they've performed over the last year? just a bit of context. If you go back 2 years, a lot of these companies were down 50% or more during 2022. And if you look over a 2-year period, say from 2022 to the end of last year, some of them are still down, NVIDIA being the one exception. But context is always important when you look at historical performance, because how far back do you really need to go? So from that type of risk is not something that we're too concerned with. We're more concerned with the fundamentals of the business and whether or not the price that's been asked makes sense on what we think the business can do going forward. And for some, we are less concerned. Some we maybe are a bit more concerned. One name in particular, which we do have a bit of a question mark over, is Apple. So Apple, in theory, is very well positioned to benefit from AI. The iPhone is basically the central device, at least from a consumer perspective. The people's lives revolve around their iPhone. So if you're going to be running some kind of AI, you're going to run it on your iPhone. And Apple's also synonymous with privacy. They want people to feel safe and secure with their data. So if someone's running some kind of an AI model, they would be uncomfortable maybe with some of their data being sent off into a cloud and put into some kind of AI model. They'd rather it stay on their phone. So the question is, will Apple come out with some AI applications or models that run on the iPhone rather than being run in some huge data center? We don't know yet. That's been one of our concerns with Apple. They've been quite reticent in terms of what are they doing with AI. And that filters into a bigger, I don't want to say concern, but the question mark about Apple is, where's the growth going to come from? Because at the end of last year, Apple was the biggest company in the world, over $3 trillion in market cap. You look at the growth prospects for the firm, it's not expected to grow at some kind of phenomenal rate. If anything, growth might continue to come down for the company. They really benefited during COVID when people started working from home. They bought laptops and iPhones and all these electronic devices. That was a big boon for them. But that period's over now. So where's the next piece of growth going to come from Apple? If anything, people are keeping their iPhones for a longer period. The replacement cycle for the iPhones incrementally getting longer. And that's a negative for their growth. You could say that they will make more money from services. Basically, that's subscriptions. You could subscribe to Apple Music, your iCloud, whatever subscriptions you have on your Apple phone. That's becoming a bigger part of the business and it's more profitable. But I don't know if that's enough to justify that $3 trillion market cap valuation. The other area that they could grow into is through new products and new geographies. So last year, they teased out the new headset, the Vision Pro, which I think launches at the beginning of Feb. If you've got $3,500, you could be the lucky prize. I think one mustn't forget, when the iPhone first launched, it wasn't an instant success. It took a while for it to get going. And that might be the same case for the Vision Pro. If it does, we don't know. It's very much an unknown. In terms of geographies, I think they look into India as a new region that they can grow into. Massive population to grow into, but a lot of that population is below the poverty line. Can they afford a rather expensive device? We don't know. So again, a big question mark about that for the growth area. I think we've got to come back to artificial intelligence, because if they are able to come out with applications and models that people want to use on the iPhone, that could drive growth for the iPhone once again, because people will probably have to replace older models to get newer models that are capable of processing artificial intelligence application on the phone. We just need Apple to
have that functionality.
They just need to tell us what's going on. And that's why we have the question mark on the company. But we still hold the company. We just maybe squirming in our seats a bit. The one point on artificial intelligence, while these companies could benefit from it significantly, there is a possibility it could completely upend some of their business models. You think about how you search for something on the internet, you go to Google. They have over 90% market share when it comes to search. Advertising is their bread and butter. They make so much money from advertising when you search on Google or maybe use some other platform. What if AI changes how we search for things? What if instead of going to Google, we ask some assistant to search for us? That advertising money might start drying up. We don't know. But again, we've got to consider both arguments when we look at artificial intelligence. We can't just be gung-ho and think they're going to be the complete winners.
Yeah.
Right now, they look very well positioned, but we're constantly monitoring these things to see what's changing. For Craig, we've spoken a lot about the future and AI and what could happen and what can't happen. I think we have to say, at this point in time, there's so many unknowns. To say anything with certainty around AI, I think it would just be a lie, because we just don't know. We can hypothesize till we're blue in the face, but we can't really say with certainty how things are going to pan out. What we can do is control our investment process and how we look at businesses and how we invest. And how do we do that? Tell the audience how we, go forward. How do we invest in companies?
So we're looking at companies that fit the quality or tick the quality box, and that have shown over time that they can produce good cash flows, good economic profits, above their cost of capital. So firstly, they must have a good history of having done that. And then our expectation, that's maybe where a little bit of our own thinking comes in about that growth going forward, if it's going to be maintained. And as you mentioned, maybe sometime there's question marks like on Apple. But that's where our job really, gets going. So we look at the quality side, we look at the growth outlook, the growth history, and that's what we do. We look through cycles as well. So at the moment, maybe some of the luxury stocks aren't doing so well. The consumer staples aren't doing so well. They'll have their time in the sun again. As you say, we don't know exactly how the AI is going to play out, but NVIDIA is a stock that has incredible highs and incredible lows, and it's going to continue to do that probably over time. And we're going to look through those cycles. As long as the companies that we invest in fit that quality and growth style and have those characteristics, those are the stocks that we're looking for. I think we'll continue to do that, continue to investigate, probe, and look for those companies that have those characteristics, and make sure that the companies in the model continue to have those characteristics. And if things should change, if the environment should change, and those things might be impacted, growth might be impacted in a stock, then we'd have to have then we will have a rethink about, including that stock in the portfolio.
Craig, I think that's a very good note to end on. Let's hope we have another successful quarter. We don't know what's going to happen, but I think we can leave it there. So Thank you for joining us, and we'll see you in the next quarter. Bye for now.
Thanks, everybody.